The Federal Housing Administration Modernization Act that's going to be considered shortly has a number of problems, but the biggest problem is that it would reduce or eliminate the amount of money that a borrower has to put down when they take out a mortgage. The current law says that for every $100,000 the borrower has insured by the FHA in their mortgage, they must put down $3,000 of their own cash. The proposed law would reduce or eliminate that to a large extent. If that happens, study after study shows that if the borrower doesn't have their own money in the game, they're much more likely when a problem comes up to just walk away from the loan. If they walk away from the loan, then the Federal Housing Administration has to repay it, and that means essentially that that money comes from the taxpayer. The administration has proposed to allow borrowers, some borrowers anyway, to refinance their loans with an FHA guarantee. And what this would do is reduce their interest rate, and it would change things to a fixed rate loan. The problem with this is that what's going to happen is called moral hazard. The financial institutions are going to refinance the largest loans because they won't have that risk of that one defaulting anymore. And we're going to see loan after loan after loan pushed onto the FHA guarantee. We have seen in past problems, the savings and loan industry just being one of them, that when the government guarantees private lending without great standards or anything like that, that the risk of default goes up by just exponentially. When that happens, if that happens, the FHA will come back to Congress and say, gosh, we've spent all of our reserves. We need a few $100 billion to bail us out. Please send the check to this address.
For more information, log on to heritage.org.